Well, good morning and welcome to Next Generation Trust Services Encore Presentation Webinars. I am Karen August. I'm the Business Development Rep for Next Generation Trust Services. I'm going to give a brief overview of self-directed IRAs, just so everybody's familiar with self-directed IRAs and how they work. I'm welcoming Adam Sharp of Early Investing, and he's going to talk about alternative investments with early investing. Welcome, Adam.
Thanks a lot, Karen. Yeah, we think you guys are doing a lot of neat, innovative things with self-directed retirement accounts, and it's a great fit for the type of private investments that we focus on. So thanks for having us.
Awesome. Okay, great. So, self-directed retirement plans, this is just an introduction to the basics of investing in non-traditional assets within a retirement plan. So we are a third-party administrator. We're local professionals. We have all the experience in walking you through the paperwork. We are not a bank. We're not a financial planning service. We do not give advice. We don't endorse. We don't recommend. You all have to do your due diligence before investing with your self-directed IRA. So what is a self-directed IRA? It allows you to invest in non-traditional assets using your retirement plan funds. Self-directed IRAs are similar to regular IRAs. They've been around since the inception of IRA accounts. The investments keep your funds tax advantaged. And it's, establishing an account with us is opening up a whole new world to diversify your portfolio and the number of allowable investments that you can have in your self-directed IRA. So again, traditional IRA can be self-directed for tax-deferred investing, a Roth for tax-free investing, a SEP IRA for self-employed individuals, a simple IRA for small businesses. You can also self-direct a portion of a qualified plan, such as a 401k, a solo K. You can also self-direct Coverdell, educational savings accounts, and health savings accounts as well. So the options for funding an account, you can make a contribution, a personal contribution of your allowable annual contribution limit. You can also transfer funds. So if you have an existing IRA with another custodian, you can transfer those funds into a self-directed IRA. You can roll over from a 401k from a previous employer, and you can roll those funds into a self-directed IRA. And then you can also convert from a tax-deferred account to a Roth for tax-free. This is just a chart for the 2015 maximum contribution limits. So if you are under 50 years of age, for a traditional, the maximum contribution is $5,500 a year. If you're over the age of 50 and older, you can contribute an extra $1,000, so you can contribute $6,500. So we have all those contribution limits. We do have restrictions. There are disqualified persons. The IRA holder is a disqualified person, as well as the IRA holder spouse. Your ascendants, so your parents, your grandparents, your descendants, your children and their spouses, any business partners, they would all be disqualified persons. There are prohibited transactions as well. You cannot invest in life insurance in a self-directed IRA, collectibles, antiques. If you wanted to have a car collection, you cannot have that in a self-directed IRA. A wine collection, artwork, those types of things are prohibited from your self-directed IRA. But like I said, it opens up a whole new world of investments. So instead of being tied to traditional investments, stocks, bonds, mutual funds, where you're at the mercy of your broker, you have an interest in investing in a startup company, you can do that with a self-directed IRA. You can hold investment real estate, precious metals, all types of things that you probably never would have thought that you could invest in a self-directed IRA. So like this is a real estate example. So if you were to find investment real estate, you would open up a self-directed IRA and fund it with at least enough funds to put a deposit on the property. So we would give you our starter kit for our self-directed IRA. We can, walk you through how to fill it out. Then either you're transferring funds from an existing IRA, or if you're rolling over funds, those forms are in the starter kit as well. Once we have your account open and funded, then you can put a deposit on a property. The purchase contract would be negotiated in the name of your IRA, so it would be Next Generation TS for trust services, FBO for the benefit of your name, your IRA, and your IRA number. Then you would submit the approved contract for the real estate to Next Generation Trust Services with the deposit instructions. We would execute the contract, submit the deposit. You would do your due diligence, your home inspection, your title search, your tank locator, submit the approved closing documents to Next Generation Trust. We would execute those, and your IRA would hold an investment property. So all the income, the rental income for the property would come back into your self-directed IRA, and all the expenses for repairs would come out of your self-directed IRA. So that's just a little overview. If you have any more questions, you can go to our website, www.nextgenerationtrust.com. You can email me, Karen A, nextgenerationtrust.com. Feel free to call us. We do have documents on our website. We would be more than happy to, discuss the whole application process and, transferring funds or rolling over funds from a 401k. So that's my presentation. I would like to turn it over to Adam so that we can hear more about early investing.
Great, thanks a lot, Karen. So yeah, what I'm going to talk about today are private investments in startup companies that can also, be held in your, in your self-directed retirement account. So there's a lot of different options here. You can invest in private tech companies at very early stages. You can invest in retail companies that are later stage. There's a lot of different options here. But basically, self-directed IRAs are really one of the ideal places to keep this type of investment because the potential returns are very high, and you do really want to avoid as many taxes as possible on these types of investments. So let me just give a quick rundown of what I do. I run a site called earlyinvesting.com. We focus exclusively on private markets. I've invested in 52 early stage startups. I've built multiple successful small businesses. The first one when I was 25. I was, for a very brief time, a financial advisor. And now I focus solely on private investing. All right, so the big question I get from everybody is why private investments now? So there's a couple reasons that I think now is the ideal time to be in private markets as opposed to public. So today, if you haven't noticed, tech companies are waiting much longer to go public. By the time they actually IPO today, tech firms are usually past what I call their peak growth period, so their fastest period of growth, when they're growing almost exponentially. Almost nobody goes public during that time these days. Usually by the time they go public, a large tech company like Google, say, is already going to be worth $24 billion, or Facebook was already worth $72 billion when it went public. So most of the gains have already been captured by that point. There's only so much larger that a $74 billion company can get. So you're never going to see the types of, just extreme returns that we saw with companies like Microsoft, which went public in 1987. When Microsoft went public, it was a $500 million company. So there was obviously a lot more room for growth than a multi-billion dollar company. So in the first 10 years, Microsoft returned roughly 15 times what Google did in its first years, just as one example. So just because of ways that the security markets have changed, most of the gains have shifted to the private markets. A lot of it has to do with legislation that has made it harder to be a public company. So these are trends that are not going away anytime soon. So this is just one reason why I think that private markets are extremely important, and they should be a part of most people's portfolios. All right, here's a slide from a company called Andreessen Horowitz. They're one of the leading venture capital firms in the world. They backed companies like Facebook and hundreds of others. It basically just shows that, as you can see on this chart, the black line shows the portion of gains that were captured by public market investors, like after the IPO, versus private market investors in orange. So you can just see right here that a company like Oracle that went public in 1986, they delivered the vast majority of their gains to public market shareholders. And that trend has really changed since around the year 2000. You can just look where Google, Salesforce, all these companies have delivered only a tiny, tiny slice of their returns to the public market. And this is a trend that, if anything, seems to be getting stronger. We probably won't see Uber go public, for example, until they're they're already a $50 billion company. So we probably won't see them go public for at least another couple years. And by the time they do, they might be a $100 billion company already. All right, so just in general, the bar for an IPO is also much higher now. It used to be routine that when you hit $20 million in revenue, you go public. Not anymore. As you can see, the average IPO's revenue has climbed pretty dramatically from about 20 million to almost 100 million today. So it's just harder to IPO. Markets are more skeptical, and companies basically stay private as long as they can, and it makes sense for them to. So this is why I think this market is worth paying attention to. So basically, the implications are that public market investors are missing out on the vast majority of equity gains. All these gains are being had by private shareholders in private markets. So the fact that private markets have moved online and they're opening up to more and more people is a pretty important trend. And I think in a couple years that will be obvious, but right now it's not. All right, another reason why I think private markets are really important to pay attention to right now. This is a tweet by one of my favorite investors. His name is Naval Ravikant. He is the founder and CEO of a site called AngelList, and you can actually invest in startups online on AngelList today if you're an accredited investor. Anyway, so what he's saying here is that in 1999 it was at least $5 million to launch a software product. You had to buy the servers, you had to buy extremely expensive enterprise software to develop it, and you had to hire multiple developers. At the time, in '99, there were about 30 million serious computer users. 30 million. So, okay, fast forward to 2014, $5,000 to launch a product. Seriously, single developers can launch a product themselves and market it, kind of prove out their thesis on a software product for $5,000 today. So you've gone from 5 million to 5,000 to launch a product. And all of a sudden, we're up from 30 million internet users to 3 billion serious phone users. So pretty soon, there's going to be more smartphones than people on the planet. As you can tell, it's just the growth in internet users has been exponential. And meanwhile, the cost to develop software products and tech startups has dropped dramatically. So it's a very, very powerful combination. So today, for now, only accredited investors can invest online, but that's going to be changing very soon, as I'll explain in a minute. So today, if you're an accredited investor, which means you have income of $200,000 for the last 2 years, or if you're married, you have income of $300,000 for the last 2 years, or you have a net wealth of over $1 million, excluding your primary residence. Hopefully all these rules will go away soon, but for now we have to deal with them. So today, accredited investors can go online and invest in late stage, what we call pre-IPO companies like Spotify. These are already companies worth billions of dollars that would have gone public. 20 years ago, Spotify would already be public, but as one of the largest, well, probably the largest music streaming service in the US, they're still private. But you can go online today if you're an accredited investor and invest in companies like Spotify for as little as $5,000. So we actually run a service for accredited investors, and we got investors into Spotify for at around a $4 billion valuation in 2013, and today it's worth over $8 billion. So that's just one example, but you really can, access these private companies online in an extremely easy way. And these are, like I said, these are companies that would have been public 15 to 20 years ago, but because of various legislative changes and laws that make it harder to be a public company, we just don't see as many going public anymore. So on the other end of the spectrum, this is what I really like. You can invest in early stage startups, so companies that are valued at anywhere between $2 and $30 million. And you can invest along top tier venture capitalists and angel investors. And you can do it for starting at $1,000 per deal. So these are companies that are extremely early in their life span. They're just starting out. They probably have, at least a little bit of traction to show kind of what they're capable of. But usually it's only a couple employees, maybe 3 to 10, 12 employees, with an idea much bigger than what they currently have, in terms of actual customers. But what you want to look for at this stage is really just a strong leadership, companies who are led by people with domain experience, meaning they've been in this industry before. Ideally, they have experience. Hopefully, they have some, good entrepreneurial experience on their resumes as well. You also want to look for good co-investors, and I'll explain that in a couple slides later on. So anyways, what it boils down to is there's two choices for investors primarily online. You can go early stage, where companies are worth $2 to $30 million, or you can go late stage, companies that are valued at $1 billion plus. Spotify, Dropbox, Palantir, SpaceX, Lyft. So companies like that. These are very, very large, well-established companies, but they still remain private due to the current market conditions and various other factors. All right, so just a basic, breakdown of the pros and cons for early stage versus late stage. So for early stage, the pros are obviously that there's a larger potential for gains. Literally, 100 times your money gains are not too uncommon. I say that with a little bit of, reservation, because I've seen them happen. I've had 40 times myself, but 100 times is relatively rare, and you have to go in realizing that 7 out of 10 companies are going to fail, just on average. Some people say more, some people say less, but the majority of companies you invest in at the early stages are going to fail. So that's very difficult for most people to accept. So I can understand why some people are reluctant, but in return for that, it's a risk reward versus equation. So you can actually get you just have to maintain an extremely diversified portfolio if you're going to go early stage. You want at least 20 of these things. It requires really, really good diversification and what I call picking ability. So you have to be able to, pick which ideas are good and could turn into large, profitable businesses. There's also an extremely long timeline. It's 5 to 7 years, sometimes longer. So it's going to take a while until any potential exits come up, if you're lucky enough to get an exit. And now an exit would be considered an IPO or an acquisition. Sometimes as well, companies just shut down and they'll return what capital they have left to investors. And you might get 20 cents on the dollar, you might get 50 cents on the dollar. I've had both happen. So yeah, you just have to realize that even though there are extremely high potential gains in this, it is risky, but this is where I like to focus and spend my time. All right, so late stage pre-IPO, the pros are that these are established companies with high growth rates. Most of the time, they're growing faster than well, if you pick the right companies, they're growing faster than anything in public markets right now. There's just not a whole lot of really high growth tech right now in public markets. Most of it is really in biotech and mergers and acquisitions. So anyways, but most of these companies would have IPO'd already 15 years ago, like I've said. Another pro is that there's a shorter timeline. Some of the downsides, there's less potential upside versus early stage. That's pretty self-explanatory, but these are companies that you don't have to sell when they IPO. You can continue to hold the shares, just transfer them to, you can have the broker transfer them to your account. So yeah, there's a lot of different options here. All right, one thing that people are always concerned about when I tell them about private tech companies is, their mind goes right to the word bubble. So to address some of that, so this is one of the charts I like to bring up. It just shows online revenue over time. Since 1999, I think it goes until the end of 2014. So as you can see, in 1999, the entire internet in the US was generating about $25 billion worth of revenue. Today, we're up well over $350 billion worth of revenue. So it's not exactly that they were wrong in 99. It's just that they were a little bit of, the entire market got ahead of itself. We've really come a long way. There's now 3 billion internet users in the entire world. Soon it'll be everyone. So this is definitely a space to watch. There's a lot of disruption going on in pretty much every market you can imagine across the US. All right, so where can you invest today? These are my personal favorites. AngelList, which I mentioned earlier, that quote by Naval Ravikant. This is his site, him and his partner. So Angel.co, AngelList, they've had a bunch of large successes. These are a few examples. One of them is Alt School. That was an early stage deal hosted on AngelList. And it's an alternative network of schools, not surprisingly. And they did part of their seed round, which is their first round of funding on AngelList, and they went on to raise a lot of money from Andreessen Horowitz, which is one of the best venture capital firms in the world. Their last round, they raised over $100 million, so they've had a lot of success. Ship is another one. It's a startup that was listed on AngelList back in 2013 for their seed round, early stage, once again. If I had to guess, I would say it was probably valued at somewhere around $8 to $10 million at that time. And today it's over 250 million. BP is another one. It's kind of a used car network. I actually haven't looked into this one too much, but I know that they did part of their seed round on AngelList, and it's gone on to be worth over $1 billion. WeFunder.com is another one. I know the founders of WeFunder, especially Mike Norman. He's the CEO, very good guy. So one of the first companies they ever listed was called Zenefits, and this startup is really disrupting the entire HR payroll market. They've gone from being worth $7 million to $4.5 billion, I believe, was their last round. So, investors in that deal, I forget exactly what it was, but it's at least 300 times their money. So, deals like this do happen, and they're not as rare as some people would guess. Ubiome is another good one. It's a microbiome technology company, which just means the bacteria that live, live in, I'm trying to remember the word, symbiosis with humans. Anyways, moving on. Seedinvest.com, that's another good one. Ryan Feet is the CEO. And fundersclub.com, they've also had some big successes with Instacart and Zoomcar. Microventures.com, they're more of a late stage portal. They also do some early stage stuff, but Microventures is another good one. I know the CEO quite well, Bill Clark, good guy. So key due diligence points if you're tempted to get into early stage investing, one of the first things you can look at is your co-investors. Who else is investing in the round? You want to look for people with good track records. They've led companies to IPOs, large exits. That basically just takes elbow grease. You have to go out there and research all of the VC firms that you see are co-investors that are in deals that you're looking at. So it basically just takes a lot of time getting comfortable with all the different VC firms, tracking their progress. And after a while, you get comfortable with kind of everybody's investing style. And that's really one of the easiest ways to do due diligence if you're an online investor. Essentially, you can just look at your co-investors and see who else is investing. If Andreessen Horowitz or Khosla Ventures or one of these really good VC firms is investing, it's probably at least worth further examination. Product market fit. Are these people going to be able to figure out product market fit? It's kind of a hard thing to describe, but it basically is when it's proven that there's demand for what these people are selling. Sometimes early on you have to guess whether it's going to be there or not, or make an educated guess about it. If you just search for product market fit on Google, you'll find a lot more information about this concept, mostly from VCs and angel investors. So it's a very important topic, but probably one we don't have time to get into today. So early traction is important when you're looking at an early stage deal, but I do always tell people to watch out for false signals from warm introductions. So what all that means is that sometimes when a startup is first starting out and they've raised some money, they get a lot of introductions from their investors. So their investors will introduce them to anyone they think could do business with them, their friends, business colleagues. And so early traction is not that hard to get, actually. It's maintaining that early traction. Do they actually provide something that's valuable and that people want to stick around for? So even these warm introductions, after a while, if they're not using the product, they will drop off. So it's just something to be aware of, that there can be kind of false indicators of progress based on how they are generating their leads for their business and how they're closing them. So definitely talk to them about what they're doing for marketing, where most of their current business is coming from. And you'll find that most founders are actually very open to these discussions. It's good for them. It helps them practice their pitch and helps them, get more comfortable with their potential investors. And it helps them, just think about their business in a deeper way. So good founders, anyways, are happy to talk to potential investors. All right, so private investments, just as a kind of general rule, shouldn't make up more than 5 to 10% of most accredited investors' portfolios. And the other thing is, only do it if you're willing to put in the time into research and diligence. And in the case of early stage investments, only do it if you're assuming that you could lose everything and be fine, because a lot of early stage companies, like I said, do go out of business. So you just have to be comfortable with the fact that even if you build a diversified portfolio, you might just get unlucky. So you do have to go into it with a certain mindset where you're accepting of risk and you're realizing that you're not putting too much of your portfolio at risk here. So a little bit more about our service. Early Investing is our free newsletter. You can you can go to our site, earlyinvesting.com, and sign up for that. And then Startup Investor, we basically just do research on private deals and startup investments for members. It's not currently open to new members, but if you sign up for earlyinvesting.com, we will notify you when we are. Our track record, so since we opened in 2013, we've recommended, actually it's 24 individual startup recommendations now. I need to update that slide. Here's just a couple examples. Connect.com, so when we invested, or when we recommended members invest, they had 200,000 members. They've since grown to over 5 million users, and they're one of the fastest growing social networks in the world. And they recently just expanded to China. So geekatoo.com is Uber for tech support. Basically get a geek on demand. I think I might be running out of time here, so I'll speed through these. Trustify.com, find a private investigator online. This one's really neat. It might not sound that interesting, but just look into it. It's a neat deal. Dealflix.com as well, go to the movies for less. They've signed up more than 2,000 theaters, and you can go online and buy packages that include multiple tickets, and often they include food, and it's a lot cheaper than you would get if you just paid retail. All right, want to say thanks to Karen for having me, and Next Generation Trust. So once again, to learn more, just visit earlyinvesting.com, and you can also email me at asharp@earlyinvesting.com with questions. Thanks a lot.
Well, thank you so much, Adam. And I want to thank everybody for joining us today. Adam had some great content in his presentation. And again, thank you so much, Adam, for joining us today.
My
And
pleasure.
please email us at info@nextgenerationtrust.com so that you can sign up for our newsletter, so that you can get all the information for this webinar, any other upcoming webinars, so that you're informed. We would email you our monthly newsletter and have all of our upcoming events, and even events where I will be live, so that if you wanted to come and meet me, you can meet me as well. So I want to thank everybody for joining us, and have a great day.